Hi everyone, my name is Justin. I am a CPA here in Pack Tax Centerville. Today I want to talk about understanding education credits and deductions that can go along with education. As we look at the increasing expense of college education these days, these tax credits and student loan interest deductions really can help offset some of the costs we're incurring. They won't pay for the tuition, but they certainly do help. So, what we're going to want to talk about is some of the differences in some of these credits. There's non-refundable tax credits that help reduce any taxes that we owe. There's refundable tax credits that are available that actually will give us a refund even if we don't have any tax liability. And there's the deductions that we can take for particularly student loan interest that help reduce the amount of income that we pay taxes on. Lastly, one of the things I want to touch on is should my college student file his or her own tax return? And we want to talk about why sometimes there might be some money that can be left on the table if they file their own tax return. We're going to talk about the biggest credit that's available out there. It's called the American Opportunity Tax Credit, and it's up to $2,500 of a tax credit per eligible student per year. How it works is it covers 100% of the first 2,000 in qualified expenses and 25% of the next 2,000 to get up to that 2,500 of credit. Those eligible expenses here are going to be tuitions and fees, any books that are required for the courses, if a laptop is required to help do the schoolwork, turn in homework, etc. That will also be included, as well as any lab fees, any direct costs that are paid to this school. A couple of the rules for the American Opportunity is this one is limited to only 4 years of post-secondary education. So this is, we think of those freshman, sophomore, junior, and senior years of college. You have to be at least a half-time student, and one of the rules on this credit is you do have to be pursuing a degree or certificate. One of the really cool things about this credit is there is a refundable portion of it. So the $2,500 can reduce the tax liability, or if an individual doesn't have $2,500 of tax liability, they can get a refund of up to $1,000 for going to school, even if there's no tax liability. One of the important considerations here is this credit does phase out as income increases. So you see those phase outs to 100% being not eligible for a credit if as a single taxpayer income's over 90,000, or if we're married filing jointly that income is over 180,000. Unfortunately, the credit does completely phase out. I want to go through a couple of examples here of how this can apply. John is a sophomore in college and paid $3,500 in tuition and $2,000 in room and board to a qualified institution, and he did receive a 1098. So the result on John's taxes here is he's going to qualify for the American Opportunity Tax Credit. He has $5,500, so both that tuition and room and board, as eligible expenses. His credit's going to be 100% of that first $2,000, so $2,000, plus 25% of that next $3,500, which really is $875, so $2,875. However, that credit is capped at $25, but he's going to be able to capitalize on the full amount of the credit as a $2,500 tax credit. In our second example here, we're going to assume the same facts, except for John still lived at home, didn't pay any room and board. He's still going to qualify for the American Opportunity Tax Credit, though, based on that $3,500 of eligible expenses. So he's still going to get 100% of that first $2,000, and he's going to get 25% of that subsequent $1,500, which is $375. In this case, John's going to get the American Opportunity Tax Credit of $2,375, which is just slightly less than the max amount of the credit that would apply. Okay, that was American Opportunity Tax Credit. As you can see, sometimes it is referred to as the AOTC. Next, we're going to talk about the Lifetime Learning Credit. which is sometimes also just referred to as the LLC. This is a fabulous credit, especially as a student goes past 4 years or goes on to a master's degree. It's a credit up to $2,000 per tax return. However, there's no limit on the number of years it could be claimed. It could be claimed for 10 plus years on somebody's tax returns. It covers undergraduate, graduate, or job skills courses. However, it must be paid to an accredited university, college, or vocational trade school. The one thing there is you've got to receive a 1098 from the institution. Unlike the American Opportunity, the Lifetime Learning Credit doesn't have a refundable option. However, it can help reduce your tax liability. It's got similar phase outs as income comes up. A couple of the different rules on the eligible expenses is, in this case, for required books, you see the computer and the lab fees kind of go away. And with the books, they've got to be more so purchased directly from the school. And they will be included as part of that 1098T. So going into some examples on how the lifetime learning credit can apply is John is pursuing a master's degree and paid $6,000 in tuition and $3,000 in room and board. So in this case for John, he's going to qualify for the lifetime learning credit, but he's only going to be able to include as part of the expenses of that credit, that's $6,000 in tuition. The credit is 20% of those expenses, so 20% of that $6,000 is $1,200 in tax credits. What I love about this credit is it doesn't have to be towards pursuing a degree, which is our next example. So Sally noticed that her computer skills weren't as good as she needed to have them to be for her job, and she enrolled in a school and took a class to improve her job skills. She paid $1,500 in tuition for that course. In this case, because Sally did take that course through an accredited university that's going to issue her a 1098, she is going to qualify for the lifetime learning credit to help offset some of those costs for her. So on the $1,500 she paid, she qualifies for 20% credit of those costs, which means she's going to qualify for $300 of tax credits through the lifetime learning credit. Kind of reviewing back and forth a little bit between the two, the American Opportunity and the lifetime learning credit. You'll notice the American Opportunity is slightly more. It's at that $2,500, and you really, to max it out, you've only got to spend $4,000 in qualified expenses. For lifetime learning, you've got to spend more, about $10,000 to get the max amount of that credit. 40% of that American Opportunity is a refundable credit, so you don't have to have tax liability to offset it, where the rest of the American Opportunity and all of the lifetime learning credit has to offset tax due. You can only take the American Opportunity credit for 4 years. For the lifetime learning, you don't necessarily need to be seeking a degree. You can see for both of these, the phase outs are the same. If the income increases, we might not be able to claim the credits, and a 1098 is required for both. Just as a reminder, student loan interest is also deductible. It's a deduction, not a tax credit, so we can deduct up to $2,500 of student loan interest per year that will help reduce the amount of income that we pay taxes on. It does phase out as well. The phase out's slightly different in the bands, but it does phase out as well and becomes non-deductible as income rises. Okay, one of my favorite topics. Our college kids are amazing. They do such awesome things, and many of them, with summer jobs and other part-time jobs, get their W-2s at the end of the year and quickly file tax returns. What I want to caution is that sometimes we might want to have them slow down and look as a combined kind of family unit as to what makes the most sense. Oftentimes, these students can still be claimed as dependents on their parents' returns. And when it comes to the American Opportunity Tax Credit in particular, the parents often can qualify for larger amounts of those tax credits when the parents claim the child on their return. So, one of the tips here is we want to coordinate before they file. It could mean an extra $2,000 in credits for the family if they pause. We'll go through an example. Bob is a college junior and lived away at school and had some expenses. $6,500 in tuition, $2,000 in room and board. He did receive a 1098-T and he earned $12,000 of income from a summer job. His parents, John and Sally, made a combined $1,500 of total income. So if Bob were to go and file his own return, his $12,000 of income is below the standard deduction. Therefore, he's not going to have any taxable income or tax due. He'll qualify for the American Opportunity Tax Credit, but only will be eligible to receive $1,000 of that credit for that refundable portion. However, if Bob were to coordinate with mom and dad and be claimed as a dependent on their return, they're going to be able to claim the full $2,500 of that American Opportunity Credit, and then an additional $500 credit as the other dependent credit. So they could receive, by claiming Bob, $3,000 of tax credits, where Bob filing on his own is only eligible for $1,000. So it's important to pause and see what's going to work best and see if mom and dad, John and Sally, can really claim Bob as a dependent on their tax returns. Depending on, in this situation, Bob's not making enough money on his own. Parents are going to be helping provide a lot of the support here, and they could claim him and get a much larger tax credit for him. So, a couple of things just to kind of keep in mind is we need to hold on to that 1098-T and hold on to detailed receipts to help substantiate the credit. Only one credit is allowed per student per year. You can't take both credits. We're going to take one or the other. And you can't use the same expenses for multiple benefits. So if we're taking a computer, we need to take it once in the year we actually paid for it. Same thing with tuition. Sometimes tuition gets paid at the end of the year for the following year. The credits really refer to when the tuition was paid, not necessarily for what years it's for. And the other thing is to keep in mind is looking at those income limits. The phase outs can disqualify higher earners, at which case sometimes it does make sense for students to file their own return and qualify for some of the credit. In summary, the American Opportunity Credit is a fabulous tax credit for those first 4 years of education. After this gets exhausted, the lifetime learning is there for any continued learning that happens, whether that is, if it takes 6 years to get through a bachelor's degree, or onto graduate school, or improving job skills, learning new tasks later. Keep in mind your student loan interest. If we are paying those, there's forms that you'll receive and deductions available on your tax returns. And I just always recommend pausing, talking to a tax expert, looking at what can we do with the college kids at the time of filing, because there is quite a bit of money that can be lost. Again, this is Justin with Pack Tax Centerville, and I hope you enjoyed this presentation.